Good evening, ladies and gentlemen. I welcome you all to HDFC Asset Management Company conference call. We have with us today Mr. Prashant Jain and Mr. Ashok Kannawala from HDFC Asset Management Company and Mr. Krishnan from Integrated Enterprises India Private Limited. Now I hand over to Mr. Krishnan to begin the call. Thank you and over to you, sir.
Yeah, thank you, operator. And very good evening, ladies and gentlemen. This is Krishnan from Integrated Enterprises and welcoming you all to this conference call with Mr. Prashant Jain, Executive Director and CIO of HDFC Mutual Fund. I think we sincerely feel we have this conference call maybe at the most appropriate time, as you know the entire globe is surrounded by this pandemic and lot of pessimism everywhere, lot of uncertainty everywhere in every front. So in these, I think, testing times, to clarify our apprehensions, doubts and all, I think we can't think of a better person than Mr. Prashant Jain of HDFC Mutual Fund. Before I hand over the proceedings to Mr. Prashant, briefly about him. He is the Executive Director and CIO of HDFC Mutual Fund, and you may be knowing HDFC Mutual Fund is the number one fund house of this country with a total assets under management of more than 3 lakh crores. And after which the equity portion alone is more than 1.25 lakh crores. Okay? And Mr. Prashant Jain, he has an experience of around 3 decades. And the speciality is, I think you all might have heard about this HDFC's Balance Advantage Fund, a very popular fund among our system also. I think that he is the fund manager for this particular fund for more than 25 years. I think which is a history and record by itself. I think no other fund manager in India has handled a single fund continuously for maybe such a long, tenure. And this fund, you may be knowing, with an assets under management of, I think, 32,000 crores and above. In fact, I think many of the fund houses, the cumulative AUM itself is not this much. The single fund is commanding an AUM of more than 32,000 crores. Okay, so that's all about that, Balance Advantage Fund. And before I hand over, the proceedings to Prashant, I think I want to quote at least 2 of his very popular sayings. One is, I think, very popular and very evergreen also, which is, good investments are always made in bad times. It's a very popular this thing from Mr. Prashant. And recently, maybe a month or 2 back, I think we read one of his interview in Economic Times, where he was saying something, which is more powerful. This COVID-19 will pass, and so will be the opportunity. I think so this is what is Mr. Prashant is all about. So before, I think, once again welcoming you all, and thank you very much for participating in this con call. Without wasting much of your time, I am directly now taking you to Mr. Prashant Jain, CIO and Executive Director, HDFC Mutual Fund. Over to Mr. Prashant.
Yeah. Thank you, Mr. Krishnan, and a very good afternoon to all of you ladies and gentlemen. Thank you for being on this call. It's a real pleasure to share some thoughts with you. And these are very difficult times, and while I have a lot of experience, but as you will appreciate, COVID and this lockdown is a first time for all of us. I'm sure a lot of what I say on COVID and shutdown will be used, but only time will give us all the answers. But let me try and do my best today. So there are 3 issues that we are actually dealing with. One is the COVID and the lockdown. The second issue, what is not top of mind but is very important for India, is the sharp fall in oil prices. And the third issue, which is slowly receding in the background, is the restructuring of the Yes Bank, but I think that has some implications going forward. I think let me first speak about the COVID and the lockdown impact on the economy. There are 2 ways the economy gets impacted in this environment. One is the external impact and the other is the internal impact. Fortunately, on the external side, India is actually a beneficiary of the current environment. And that is because unlike most other emerging markets who are large exporters of commodities, including oil, or of merchandise or of manufactured goods, India is actually an importer of oil, and it is also a large importer of electronic goods and consumer discretionary goods. Because of this unique positioning of India, because of the sharp fall in oil prices, and also the likely fall in the imports of consumer discretionary goods and gold because of the economic slowdown in India, I think India's balance of payments will actually improve. And while our exports and remittances from the Gulf will also reduce, but I think the benefit of the oil prices, the benefit of the lower imports of gold and consumer discretionary goods is significantly more than the fall in exports and remittances. Therefore, I feel on a net basis, India stands to benefit on the external front. And in our rough estimate, we could end up benefiting to the extent of 1% of our GDP on the external side. It is likely that in the current year, India might achieve a trade balance after almost 20 years. When you say this, that India's external position has improved, some people are confused. If that is the case, then why has the rupee fallen? I think the value of the rupee has fallen because the FII selling in equities and bonds has been one of the most intense that we have seen in a single month over the last 2-3 decades. And while the benefits will play out over 1 year, the selling has been very intense over a month, and that is the reason why rupee has depreciated. In any case, the fall in the value of the rupee against the dollar is much less compared to most other emerging markets. And that is mainly because India stands to benefit on the external side. India will also have one more medium-term advantage of the post-COVID environment. As you all know probably that manufacturing, China is the leader in manufacturing. Over the last few years, Chinese costs, Chinese wages had gone up higher, and therefore manufacturing was slowly moving out of China into other Asian countries. India was also getting a very small share of that so far. But recently our government has cut tax rates on new manufacturing units to 15% to take advantage of that situation. So while this process was going on, I think what happens now is COVID has brought a great sense of urgency in the minds of the companies to reduce their over-dependence on China. Because the over-dependence on China led to a lot of supply chain disruptions for them. And therefore, I think there is clear evidence that manufacturing will shift out of China faster than what was happening before. And India, with its low wages, large number of skilled manpower, a large domestic market, competitive tax rates, I think is well placed to take advantage of this. And this benefit, I think, will play out over the next 2, 3, 5, 10 years. So I think this is one more medium-term benefit for India, and India has a second chance of getting back into the manufacturing which we could not do or did not do the first time in the first round. So net, I think on the external side, India stands to benefit in the current environment, and we are in a way extremely fortunate, extremely lucky to be in this country, because if we were in a typical EM which is over-dependent on exports or oil exports, I think the pain in these economies will be extremely significant. Let me now come to the impact of the current environment and COVID on the internal economy. And this is where I think the real challenges lie. 60% of the economy in India is in services. 40% people are employed in services. And the share of the lower income, 50% households in the country, the bottom half in income terms of the country, has a share of 15% of the GDP only. So that works out to a monthly income per household of roughly 25,000 rupees. So basically India is a low income country with huge dependence on services both for the economy and for employment. Also, what has happened, I don't think this is probably as true for South India as is true for other parts of the country, but the savings rate in the country has fallen sharply in the last few decades. Until few decades back, the lowest income groups also used to save, but due to the impact of advertising, due to the reach of mass media through mobiles, televisions to every household, and the availability of small ticket EMI driven loans, I think it has led to a change in habits, and therefore the savings rate has come down to my mind even in the lower income groups. So when you don't have savings and income is disrupted, I think it will cause considerable anxiety and pain to the large numbers of the people in this country. I think what is also happening simultaneously, because business will be severely impacted, the profits of companies can fall sharply. It can be quite adverse, and therefore the pressure on wages that companies will exert now will be quite significant. And we are seeing attempts at cost cutting across companies, across small, medium and large enterprises, and therefore I think the pressure on wages is going to persist. Net, I think because of loss of wages, loss of income or reduction in income, heightened fear, anxiety about the future, low savings and pressure on wages by companies, I think the impact on consumer discretionary consumption is going to be quite meaningful, and it will not go away with the lifting of lockdown. So I think if in a low income group family, if someone misses 1 or 2 months of wages, it will impact the savings or the discretionary consumption for the whole year, and therefore I think the spend on discretionary consumptions will go down, and this effect will take some time to go away. Also, some people feel that only discretionary consumption will be impacted, and some people feel that the FMCG companies, they will not get impacted. I don't think that is correct either, because the definition of discretionary is not uniform across all income groups. For a high income family to spend few hundred rupees on an ice cream or a expensive chocolate or a deodorant is not a big deal. But for someone earning 25,000-30,000 rupees a month, if 1 month's income is lost, these spends become discretionary. Even to buy a packet of cream biscuits can be discretionary for a lower income family. So I think the impact should be felt in varying degrees across the broad spectrum of products. I think after lockdown is lifted, because people have stayed confined to their homes for a reasonable time, they've been forced to think, they've been forced to change their lifestyles. So I think certain consumer habits might also change. And for example, social distancing might be practiced for some time. People might realize that it was their lifestyle which was costing a lot, and a simple living actually does not cost a lot, so some consumption habits might change. And I also think that because of the memories of this event and of the fear of a repeat, I think will encourage people to spend less and save more because they could be worried about the future. I think we will get the answers to how the consumers change only over time, but these are some thoughts in that direction. I think the current year for the economy is going to be a very challenging one. One, because of course consumption will slow down. I think even companies will postpone the capital expenditure. Whatever capex is not essential, they will postpone it. And I think when capex is not there, it again impacts certain businesses which depend on capex. It impacts wages. So I think net the economy in the current year is a very challenging year, and we exactly don't know what growth will be. but some analysts, some economists suggest that current year will be a zero growth year. But as I said, no one has a prior experience of dealing with a situation like this. So these are basically broad estimates. I think next year should be a year of very good growth, especially on the slow base of the current year. And longer term, as I said, the external environment is actually quite good for India. Interest rates are low, oil prices are low. Our demographics is to our advantage. The manufacturing moving out of China is an opportunity for us. So I think over time, growth will definitely come back to India, but current year looks to be quite challenging. Let me now speak on the profitability on companies. I think the impact on profits of companies will vary depending on the sector and depending on the nature of the business. Companies that are catering to discretionary spends, goods or services, and that have higher fixed cost structures, I think will be impacted more. And I think the impact could be felt a little more by the small mid companies compared to large companies, because many of these small mid cap companies are either small NBFCs, small banks, which have a challenge due to the developments around Yes Bank, the auto ancillaries, the small engineering companies, the retailing companies, the white goods, the brown goods companies. These are all smaller sectors, and therefore they may feel the impact a little more. Let me now describe to you the impact in terms of sectors, various sectors. So I think let me follow the Nifty's classification, because that is the most popular index, and it also covers roughly 2/3 of the market cap in India. So financials is the largest space in Nifty, and the financial side is dominated by the large banks in the Nifty, and the large banks actually should do reasonably well, because they will gain share from the smaller banks. They will also gain share from NBFCs, and they will also gain share from the bond markets. So I think the large banks, while they will also face some NPAs, especially in the small SME loans and the unsecured personal loans, the impact should be less, because the proportion of the such loans with the large banks is low. And it was the NBFCs and the small banks which were specializing or which were focusing on small ticket loans and on giving loan against property to the small and medium enterprises. I think definitely asset quality challenges will be there, provisioning costs will go up, but from this crisis, difficult time, I think the large banks will actually emerge stronger. And if you look at the valuations, some of the large private sector banks are now trading around 1x price to book for March 22. The public sector banks are even lower. Therefore, I think net the financial space looks to be quite attractively valued, and I think the current year's pain in the P&L is more or less priced in quite well, because longer term, I think these banks, when they emerge stronger, their ROE potential should justifies significantly higher price to book values. The next sector, large sector in terms of market cap, is the oil and gas sector, and the leading company there is Reliance Industries. Reliance, interestingly, is about half the value is coming from telecom, and small part from retailing, and the balance is coming from oil and gas. Telecom is one of the few sectors that will benefit in this environment, both during lockdown and after lockdown, as more people may rely on work from home or teleconferences. The refining margins could be negatively impacted in the short run, especially for large companies, complex refineries like Reliance. But if you look at the other oil marketing companies, the PSU marketing companies, the marketing margins have gone up pretty sharply, and therefore I think the impact there is a net positive. To my mind, Reliance Industries is moderately undervalued, and despite the negative impact on refining margins, and the PSU companies are significantly undervalued. They are trading below book values, and the multiples and the dividend yields are quite attractive as well. The next two sectors are IT and pharmaceuticals. Software, I think India has a leading place for software development. I think the reliability of these companies or the quality of these companies has been proven very well in the current environment. The good thing about the environment is, despite the lockdown, the systems across the world have worked fine and there have been no breakdowns. So I think these companies have played an important role in that, and they will their reputation stands enhanced. And I think while current year will be a difficult year, as customers may ask for lower prices or they may cut certain discretionary spends, over time I feel as the companies want to improve their systems, to automate more, to migrate to the cloud, or to enable work from home kind of situations, I think technology spends should come back and these companies should benefit. But in any case, analysts feel that current year is a year of mildly negative growth, and but if you look at the current prices, these companies which are world leaders, very high quality companies, generate free cash flows, they are available around 3 to 5% dividend yields. So again, I think the outlook is pretty reasonable. Pharma companies are less impacted, relatively less impacted by the current environment, and the markets are also reflecting that this sector has done quite well. It has gone up almost 30-40% in the last month or so, one of the few sectors to have outperformed very significantly. I think in the pharma sector we can also get a message about the nature of the markets. If you go back 5-6 years back, pharma sector was a very sought after sector. It was one of the most popular sectors, and it was very expensive. And over the between, I think 13-14 till last year, this sector fell almost 60-70%, despite it being extremely popular in 13-14. And in the last 1 month, it is up 40% after having fallen very sharply over the previous 6-7 years. So I think the message here is that something which is very popular, if it is very expensive, can underperform despite it being so popular. And over time, if the business becomes undervalued, it can make up for the underperformance in a very short period of time. Moving on to the telecom sector, as I said, it is a sector which is benefiting from the current environment, and even the pricing is improving in that space. Cement, I think, is a sector which, while the current year will be a weak year in terms of profits, I think these companies are valued more on replacement costs or EV to EBITDA, etc., over the cycle. So I think this sector is, to my mind, quite attractively valued. And for the first time in a very, very long time, some of the leading cement companies are available near replacement costs. So I think from a medium-term perspective, this sector is offering quite good value. The next sector is the utility sector, and this is a very interesting sector. I think this sector, the power companies were the most popular investments 11 years back in 2007-8. And at that time, this sector used to trade up to 2.5-3 times price to book value. And over the last 10-11 years, this sector has underperformed very sharply, and these companies from all the way 2 to 3 times price to book have come down to below book or just about book value in terms of valuations. This is one sector which will be very less impacted by the current environment, and earnings should hardly be impacted because power demand should come back to it should recover almost fully immediately after lockdown is lifted. This is one sector where our funds are significantly overweight, and we did not buy utilities 10-11 years back. At that time, we preferred the consumer companies, the pharma companies, and which did quite well for quite some time. And in the last 2 odd years, we have built up significant investment positions in this space, and we have been underweight the FMCG sector, which we think is very expensive. And it is this positioning of the fund which has hurt our returns in the last 1 year especially. We think the underperformance of the PSUs was not so much to do with business or operational performance, which has actually been quite decent, but it is because of the supply of stocks through ETFs that this space has experienced. And the supplying of stock at a discount through ETFs has, I think, impacted the performance of valuations of the sector. But fortunately, the ETFs now seem to have ended, and the DIPAM secretary some time back did hint that going forward the route will be strategic sale routes and not the ETF routes. I think the sector is offering great value, and I think over time it should do quite well. And when that happens, we should also be able to recover our weak performance of the last year or so. The next sector is the EPC sector. EPC basically refers to companies like Larsen & Toubro. And this is one sector where I think the impact will be felt in the current year, but medium-term impact should be limited because these companies have order backlogs for 3-4 years. And it is also likely that the government, to deal with the current economic environment, might increase the infra capex. And if that happens, that should again be good for this sector. But companies that are focused on industrial capex, I think, will clearly be significantly impacted because industrial capex will clearly get pushed out. But EPC companies which are more focused on infra capex, I think, should come back to near normal levels by next year. The 2 sectors which are left now are the FMCG and the auto sectors. Auto, I think, will be the hardest hit sector in the current environment. One, because it is the most discretionary product. The replacement demand can suffer. People may simply decide to use their existing cars for 1 or 2 more years. And even the new car buyer might hesitate to buy a new car because the impact on wages is likely to be quite significant. And this sector also has very high fixed cost structures. So this is one sector that I would be quite worried about for the current year. And if auto companies are not doing well, they would in turn impact even the auto ancillaries pretty significantly. The last sector is the FMCG sector, and this is an interesting sector. It has some outstanding companies, but the valuations here are extremely expensive, and many of these companies are trading between 50 to 80 multiples. And as I had said, around 2007-8, this was a very cheap sector. They were trading in mid-teens kind of multiples. And since then, over last 10 years, those mid-teen multiples have gone all the way up to 60, 70, 80 multiples. I think while this sector largely deals in staples, given the large impact that COVID will have on incomes, especially in the lower income groups, I think there will be impact in the discretionary products portfolio of these companies. And as I explained earlier, what is discretionary what is not discretionary to a higher income group person can and does become discretionary for a person in the lower income groups. So I think as it is, the sector was not growing at a healthy pace. It was growing, but it was not at a healthy pace. And I think in the current environment, the sector will also see adverse impact. And therefore, I feel the multiples in this sector are quite unreasonable. If you look at the markets if you look at, just to review overall, what is the picture? There are sectors which are, most sectors are offering you good to great value. The only sectors which appear to be expensive to my mind are FMCG and automobiles, at least some of the automobile companies. Sectors like private sector, oil and gas, IT, pharmaceuticals, they appear to be fairly valued to me. What that means is the returns should be in line with the earnings growth in that sectors. And most of the other sectors like large corporate banks, PSU refiners, cement, utilities, EPC, they appear to be moderately to deeply undervalued. And I think this observation that barring one or two sectors, most sectors are undervalued or fairly valued is also showing up in the aggregate market cap to GDP of the country. So India's market cap to GDP is now around 50% market cap to GDP. This represents very low, very attractive valuations. And in the past, whenever market cap to GDP has touched 50%, the next 3 and 5 year returns have been extremely high. They've been very, very high. And I don't see that, I see no reason why that should not happen this time around as well. While in the past, when market cap to GDP touched 50%, the impact on the economy was not as significant as it is today. But I think there are reasons to believe, and I feel confident in saying that over the medium term, not in the very short term, but over the medium term, the economy will come back to near normalcy levels. And once that happens, I think this market cap to GDP of 50% is unlikely to sustain. If you look at India in terms of price to book value also, the price to book value is now close to all-time lows. It is at levels with what we saw after 9/11 or after Lehman crisis. And from these market cap price to book value multiples, I think the returns in the past have been extremely good. It is also interesting to note that the last 3 months have seen the near record level of sales by FIIs, and which is what is responsible for the sharp fall in the market. On every occasion in the past, when FIIs sold very significantly, the next 12 months was a period of significant inflows by FIIs. So I think FIIs over long periods have invested in India most of the years, and that is because the growth prospects of India are much higher than the developed world. So I think over time they will realize that India is actually a beneficiary of the current external environment, which is characterized by low interest rates and by low oil prices. So I think I remain optimistic that over time, even FIIs will turn buyers. And as Mr. Krishnan had said, that if you go back and see, the best investments have been made in the most difficult times. And the reason for that is very simple. In the difficult times, the values are the cheapest. And over time, as the environment improves, these companies move to fair values or even above fair values. And that is why at times like these, while the perceived risk is very high, the real risk is actually quite limited in the markets. And therefore, I feel the risk reward for someone who can think few years and who has tolerance for some volatility, I think the risk reward is extremely favorable in these markets. I think those of us who are fortunate to have surpluses in these markets can appreciate the attractiveness of these markets from the fact that the
तुम्ही
returns
ज्या
over
व्यक्तीशी बोलत आहात त्यांनी तुमच्या कॉलला
last 10 years of Nifty have been just about 5-6%. They've been below even fixed income returns. So I think this is a great opportunity, and those of us who have underinvested relative to our risk capacities, I think this is a great opportunity, and such opportunities don't come every now and then. In the last 30 years, we have seen 3 occasions like these. So I would suggest that to the extent of our risk appetite, what it permits, we can invest, we should invest in equities. To my mind, the preference at this stage would be for large caps, and when economic environment improves, then maybe we could look at small mid caps as well. I think it would be sensible to split your investments, whatever you want to do in the next in 2-3 rounds over next few weeks or months. One we can invest now because markets have corrected so sharply. Second, the installment we could invest after a few weeks when lockdown is lifted and when we get confidence that we are winning this war against the coronavirus. And third, if we want to invest, we could invest after a month or 2 because the April to June quarter results will be the worst results, and in some cases or some companies may fall if the results are worse than what is expected. Though in my experience, my judgment, when results are expected to be bad, stocks typically bottom out ahead of those results. But I think over next 2-3 months, we should get invested to the extent of our risk appetite. I think I have actually, let me now go. Krishnan has supplied me or given me a list of some of the issues, questions that you have, and let me go over those one by one and see if anything has been left out. There is a question, what are the major challenges before government post-lockdown? I think challenge number 1 is to how to control the spread of the virus. That is the primary challenge. And when you open up, how do you do it in a way that there is no, you do it in a way that the virus does not get out of control. I think the revenues of the government will also be sharply impacted because tax collections, both direct, indirect, companies, individual taxes will go down sharply. So this will be a year where fiscal deficit will definitely go up very sharply. And therefore that limits, to my mind, the ability of the government to come out with a very big stimulus package. I personally feel the stimulus packages will be mostly directed at supporting the lower income groups where livelihoods have been impacted, and they may also try and help some of the very severely impacted business sectors, but I think we will get answers to that in few days' time. I've answered the second question also, do we expect any stimulus package? And third question is, how long do you expect the financial crisis to last? See, I think there is no financial crisis in the strict sense because India's external balance of payments, our reserves position is extremely healthy. But we do have a situation where growth will be very weak, corporate profits will be weak, people's incomes will be down, and some banks will experience a stress on asset quality. But I don't think we have a crisis in the sense some of the oil exporting countries are facing. As far as the markets are concerned, I don't know. I mean, the short term is very hard to forecast. But I have seen that around times like these, the pessimism is very high. And over time, the markets tend to surprise you with the returns. What would be the impact on Indian economy with RBI giving funds from the reserves? I don't think the RBI can give reserves just like that. They basically lend to the government or they can lend to the banks. But I don't think RBI can just distribute money like that. The mood of FIs and big global companies towards Indian economy. I think that is should be very positive. We recently saw the large investment by Facebook in Reliance Industries. So I think India is one of the leading economies in the world. It has one of the best growth prospects. So I think the sales by FIIs in the last few months should not indicate that they don't want to invest in India. When they face redemptions in the emerging market funds from which they have invested in India, they are forced to sell in India also. But over time, I think we will see that FII flows should become positive. Yesterday, there was a very large trade in Hindustan Lever, almost $3 billion, and most of it was picked up by the FIIs. So I think that is again telling us that the faith of FIIs in the country is quite intact. Do they feel more relaxation in India compared to other countries in the coming future? I think they should feel more optimistic about India because, as I said right at the beginning, India is a net oil importer and will actually benefit in the current environment compared to many oil exporting countries and other countries which have large exports to the Western world. The external side of India is actually improved. Next question is, how long the NBFC crisis continues and how can it be resolved? How badly infra companies affected? I think this NBFC, yes, I would not say crisis, but yes, there is a stress on them. And I think the government will have to intervene, or the RBI will have to intervene and to restore the confidence of the banks, of the markets in them. And I think we should wait for some time. They might come out with a separate some scheme. I think for now, the NBFCs that we have spoken to, they are, yes, there is some strain, but they seem to be okay. And I don't think we should simply expect that these NBFCs will fail. I don't think that is likely. And but it is true that the growth rates of the NBFCs will moderate very sharply, and only time can tell what is the real impact of the bad loans on this. Then, how important is the percentage of promoter holding as per your view? I think it is always good if promoters have a good stake in the company. I think it is a good indication. It gives you comfort. So, but there are many companies which have very low promoter holdings. For example, if you see in HDFC Group or L&T, there are no promoters, but these are two companies that have done quite well. On the other hand, there are companies where promoter holding was high, and still those companies have not done well. But on an average, if promoters have a high stake in a company, I think it gives us more confidence. Views on commodities and gold. Gold, I don't think I would like to comment. I don't understand that, especially to forecast it near term. I think our gold, I look upon it as an insurance, and it is an asset which will work best in crisis times. When everything else fails, gold will still retain value. There are countries where currencies have lost 30 to 50% value in the last few months. Now, gold has retained value even in those countries. Fortunately, we are not in that type of a situation in India. So I think gold is a good insurance, but I think over-investment in gold can lead to less returns also. Gold and equities have some common characteristics. Both are long-term assets and both are volatile in the near term. But over long periods, the returns on equities have been higher. So I would say that Indians, especially in South India, people who hold a lot of gold for very long periods, I think culturally we are quite suited to invest in equities if we think the same way we approach gold. Market behavior in 2021, I think, very hard to say, but as I said, whenever in the past markets have fallen to 50% market cap to GDP levels, the next 3-5 year returns have been extremely healthy, and I don't see that changing this time around as well. I think the crash of global crude price, I think this I have already explained, what is the impact of India. I think India is a big beneficiary of this. Which sectors will show silver lining for future business post-COVID era in India? I think sectors that are undervalued to my mind are large corporate banks, EV companies, oil and gas companies, utilities to my mind are deeply undervalued. Sectors like IT, pharma, I think are close to fairly valued. And the only sector that I find expensive in this market are the consumer staples companies, consumer discretionary companies, the white goods, brown goods and automobile companies, at least selectively. Views on airlines, hotel, travel, tourism, entertainment. These sectors will be the worst hit in the current year. But companies in these areas that can survive the current year, I think at some point these can become very good long-term investments because competition will reduce in these sectors due to the current environment, and strong companies that come out may actually come out much stronger. Then views on power, steel, infra, heavy engineering, automobile engineering. I think automobile and engineering will be adversely impacted in the current environment because automobile sector and private capex, industrial capex will be both down. Longer term, the sector could benefit from the shift of manufacturing away from China, but I think this is a very broad sector and it would not be possible to do justice to them with some very general comments. We have to be more focused on the individual companies. I think I have already discussed aviation, NBFC, telecom, IT, so all sectors I have discussed. Companies dependent on agriculture. I think agricultural companies should be less impacted, though I do feel that the fruits and vegetable farmers in some pockets have suffered deeply because it's a product with a short shelf life, so there have been losses. Even poultry consumption is down, so the poultry farmers also, I am told, their incomes have been impacted. But I don't think there is too much representation of agriculture in the stock markets in India. Market valuations I have discussed. Advisable to invest in financial sectors and PSUs I have discussed sector-wise. Investment advice also, there is one question. We have been investing in small cap funds for 5 to 6 years, but it is showing negative returns. What is the time horizon to reap benefits? I think this is one thought that I must share with you. I think it is human nature to chase returns. And what happened to the small and the mid-cap sector is that between 2014 to 2017, it gave very high returns. And when a sector gives you high returns for 1 or 2 years, some people think that even over 10 years or for long periods, those high returns will continue. I think that is not the right interpretation, and more often than not, what has been seen is that whenever a sector gives excessive returns, that sector has become very expensive. And therefore, there is a tendency to do mean reversion. Therefore, that sector ends up disappointing most investors who came in to that sector just looking at the high returns. So I think that is what has happened to the small mid-cap space. The sector which has hugely outperformed between 2014 to 2017 has come back to normal levels with a sharp correction in the last 2 years. I think from now onwards, in line with the comments on stock market that I made, I think the sector should deliver some returns over in the medium term. But as I said, our preference in these market and economic conditions should be to invest in large caps first. If you are holding small mid caps, you can continue to hold them for some time. I think there is a question on liquid fund, bank deposits. So I think liquid funds to my mind are quite safe. Whatever issues we have seen is in the credit fund space, and even there it is specific to a fund house, and we have followed a conservative approach to fixed income investments all along. So while there are some redemptions in the credit funds, even in other mutual funds, I think these are manageable, and we feel reasonably confident of dealing with the current environment. There's a question: when market is crashing, which category of fund should we invest lump sum amount in? I think, as I said, in large caps, and I think it would be better to invest in 2 or 3 rounds over the next few weeks or months. There's a question: should I continue stop my SIP for the time being? I think if you ask me, if your risk appetite permits, you should increase your SIP amount to the extent you can. Because in these low markets, the more you buy in these low markets, the better should be your returns over the medium to long periods. There's a question: what should one do if you have substantial amount in bank FD savings? Where is it advisable to invest? I think, you should not confuse fixed income and equity investments. You should divide your wealth in 2 parts. There are the risk capital and the safe capital. Risk capital is that portion of your wealth on which you don't want to take risk, on which you may need that money in the next few years, or you don't want to tolerate volatility on that. That portion of money you can invest in FDs with banks, with companies, or with certain fixed income mutual funds, maybe FMPs or something else. The other portion of your wealth which you feel you don't need for next 3-5 years, which you can tolerate volatility on, is your risk capital. And that is the portion you should invest in equities. So just because you have money in a bank doesn't mean you should move to equities. But if you have money and you can take risk on that, then that portion of money, I think you should definitely move to equities, especially at times like these. The question on are all debt funds in danger now because of FT? I don't think so. I think what happened to FT was it's very difficult for the investors there. But I think most other funds are better. I cannot guarantee anything, but at least we feel quite reasonably confident of dealing with the current situation. I think the fixed income markets in India are less liquid, and that is why fund managers have to focus a lot on liquidity. And we have always invested based on SLR framework: safety first, liquidity next, and returns last in fixed income. And I think that approach has helped us to deal with similar situations in the past, and we think it will help us to deal with the current environment as well. Investors in balanced advantage fund and dividend option are worried about current NAV. Your advice apart from balance funds has reduced dividend from this month. See, I think it is true that the impact of COVID, the sharp fall in the markets, the NAV has fallen, and therefore we have reduced dividends also, because it would not have been right to pay out a very high yield in this environment when returns are low and when the interest rates are also low. As and when the NAV improves, if and when it improves, I think our trustees can relook at the dividends. If you look at the last 20 years, we have maintained a reasonably consistent yield on this fund, and that is what the attempt is to do this time around also. I think those in the dividend plans could consider, because of the tax law changes, to move to the growth plan, or they could move to the systematic withdrawal plan if they need monthly cash flows. But if you don't need monthly cash flows, I think it would be better to be in the growth plan, because dividends at this stage amount to reducing your exposure to equities. And I think this is a fund has substantial exposure to equities, and that is the reason the NAV has come down. But I do feel confident that as and when the markets recover, we should do better. We have seen similar situations in the past, around 2000, around 2008, and we have recovered from those levels. And I do feel optimistic about the country, about the markets, and about our funds. But clearly, to come out of situations like these, it does not happen overnight. It will need some time. So, Krishnan, with that, I think I have completed my time also, and I've answered all the questions. Think it appropriate, maybe we could end this now. Hello?
Mr. Krishnan?
Yeah?
Yeah, I think we can conclude the call.
Yeah. I will.
Yeah.
Hello? Yeah.
Yes, please.
So, shall I continue?
Yes.
Yeah. So thank you, Mr. Prashant. It was a simple, understanding, to the understanding of everyone, but a very effective presentation. Thank you so much for that. And I think it's a fantastic insight on the economy, the corporate sector. Of course, he has covered each and every sector, in the Nifty, and maybe the investment side, which should be a staggered investment over the period of next 3 to maybe 6 months. And the impact of COVID as of now and maybe going forward and everything. I think it was a very simple, very effective and very powerful presentation. Thank you, Mr. Prashant, for that, and thank you, HDFC Mutual Fund, Mr. Ashok Khanawala and team. And on behalf of Integrated, I again sincerely thank all investors who are supporting us all these years and who have taken time to participate in this, conference call with Mr. Prashant Jain. Thank you so much and all the very, very best.
Sir, you can close the call. Thanks, everyone.
Yeah.
Sure, sir. Thank you. Ladies and gentlemen, this concludes your conference call. You may all disconnect your lines now. Thank you and have a nice evening.